The United States economy has been deteriorating over the past few years and is now on the verge of a recession and maybe even a collapse. And if you don't believe the US is in serious trouble, watch these 11 shocking facts and data that proves the US economy is about to crash. Stay until the end, because the last fact will shock you and reveal what no one is paying attention to, so you can prepare yourself to what is coming. But before that, make sure to subscribe to this new channel to see more videos about economy and interesting economic facts from around the world. Also, if you're interested in learning how to make more money, check out the link below to see the best way. So, here are the 11 signs that America is in serious trouble. 1. The Consumer Sentiment Index. From the Michigan University, a well-known and renowned economic indicator is clearly showing that U.S. consumers are losing confidence in the economy and aren't optimistic about the future. The index is a monthly survey of how consumers feel about the economy, personal finances, business conditions, and buying conditions. Because consumer spending accounts for about 68% of GDP in the U.S., the Michigan Index is regarded as one of the main economic indicators followed by businesses, policymakers, and investors. Today, the index is between 50 and 60, which is compatible with recession periods. 2. Inflation is simply out of control and now became the Americans' top economic concern. Nearly 1 in 5 Americans say inflation is the country's most important problem. The truth is that the price of everything skyrocketed, from energy and food to electronics and housing. Today, everything is significantly more expensive, and consumers are getting fed up with the effects of soaring inflation. And all of this is the result of the mismatch of a simple equation between supply and demand. Too many people chasing too few goods. This unbalance was caused by the unprecedented rounds of money printing and the supply chain shocks around the world. All of this made the inflation rate of the United States reach the highest level since 1981, and what is worse, with no sign of relief. 3. American purchasing power is shrinking in fast pace. The purchasing power is the value of a currency expressed in terms of the number of goods or services that one unit of money can buy. And to Americans, this is the dollar purchasing power. Because of the impacts of inflation, as explained before, the dollar is now weaker than ever before. Rising prices decrease the number of goods or services a person can buy. In other words, your money now buys less. Today, Americans are making hard choices and only buying the essentials for their lives. To visualize the numbers, according to the latest NPD Group research, more than 8 in 10 U.S. consumers plan to change their spending in the next 3 to 6 months because they cannot afford to spend as they used to. 4. The Fed fund rates are increasing and have no signs that it will stop. The consequence of the uncontrolled inflation rate across the country, the Federal Reserve is being obligated to raise interest rates to combat the inflation. Since the beginning of the year, it was very clear that the Fed has lost control. The speech about the transitoriness of inflation was, in fact, one of the most ridiculous economic mistakes ever seen in history. With this mistake, the Fed was obligated to raise the Fed fund rate from 0.5% to 3.08% in a parabolic way. The consequence of this is that economic activity will slow down due to the increased borrowing costs for businesses and consumers. 5. The United States economy is officially in recession. According to the latest data of the National Bureau of Economic Research, the U.S. economy shrank 0.6% during the second quarter of the 2022. That number combined with a decline of 1.6% during the first quarter of 2022 made the U.S. enter in recession. For those who don't know, the official definition of a recession is when a country has 2 consecutive quarters of negative growth, and that is exactly the current situation of the U.S. economy. 6. Stock market valuations are still very high and compatible with bubble periods. Despite the cumulative fall of approximately negative 25% in the S&P 500, the markets are still very expensive. According to the PE ratio, which is a classic measure of any security's value, indicating how many years of profits it takes to recoup an investment, the current S&P 500 PE ratio is 26.1. This is 30% above the modern era market average of 19.6, which suggests that markets are still overvalued. 7. The nightmare is not over. Another classic and well-known financial indicator shows the same information, and that indicator is Shiller PE ratio. As we can see in this image, the Shiller PE ratio is around 27.23, a number which is compatible with stock market pre-crash values, just like the Black Tuesday in 1929 and October of 2008, when the Great Recession happened. 8. Unfortunately, things only get worse. Another classic and well-known financial indicator shows the exact same information. The Buffett Indicator signalizes that markets are still getting very expensive. For those who don't know, the Buffett Indicator is an economic indicator created by Warren Buffett and shows the market capitalization of publicly traded stocks divided by a country's gross domestic product. For the US, we can use the Wilshire 5000 divided by the GDP as the Buffett Indicator. As this image shows, today, the market valuation is above the internet bubble of 2001, which clearly demonstrate the overvaluation of the US stock market. 9. US unemployment rate fell to 3.5%, matching its lowest level in the last 50 years and matching February 2020, the same level that preceded the financial market crash of March 2020. For those who don't know, the unemployment rate has a cyclical pattern, and it works as the opposite of how the common sense thinks. Whenever the unemployment rate is at its lowest level, is exactly when the economic activity is at its peak. In other words, the economy is on the verge of transitioning into a recession, and this is the exact situation of the United States economy, just as we have seen in this video. 10. The housing market is about to collapse. The 30-year mortgage rate in the US has moved up to 6.92%, its highest level since July 2007. And this level of rate is dangerous because this is the same mortgage rate level that preceded the burst of the housing market bubble of 2008. And to make things worse, the 3.9 spike in rates over the last year is the largest year-over-year increase since 1980 to 1981. This means Americans now are in real trouble with refinancing and paying their mortgages. And before we explain which is the most shocking data that reveals the upcoming crash, don't forget to like the video so we can bring you more relevant content. Also, if you're interested, check out the link below to see how to start your online business just as I did. 11. The most dangerous signal in the financial markets has been triggered, and that signal is the inversion of the yield curve. Most of the population and investors aren't aware of this signal and what it means. So if you want to learn more about it and see why a 2023 market crash is imminent, check this another video on the channel. You will see that the inversion of the yield curve is the most relevant signal before a recession and a stock market crash happens, and that signal has been triggered twice on April 1st, 2022 and July 6, 2022. Well, now that you know more about how the US economy is falling apart and how a financial crash may be near, please help this channel by telling us what other country or economic issue you'd like us to analyze. Let us know in the comments below, and don't forget to like and subscribe to our channel to see new videos about economy and interesting economic facts from around the world. And don't forget to turn on that notification bell, and we'll see you in the next one. Until next time, goodbye.